Thank you for joining us. We're just going to wait a minute or two for others to filter in and join us before we get started. Hello, everyone. I'm Caitlin Fitzpatrick with IMN, and on behalf of our team and the Fixed Income Investor Network, thank you for joining us for today's panel at the Distressed Credit Trading and Asset Performance Update, sponsored by Solve Advisors. Throughout today's session, we encourage attendees to pose questions to our panelists throughout the session through the Q&A radio button at the bottom of your screen. If there's anything you missed during today's program, this content will be available for viewing on the IMN website after the program has concluded. Now I'd like to hand things over to our esteemed speakers on the ESG task force, led by Rob McDonough.
Great, thank you, Caitlin, and welcome everyone. We've got a great panel today with a broad range of perspectives on both structured investments as well as ESG. So we're going to briefly introduce ourselves and then we'll get into the content. I am Rob McDonough at Angel Oak Capital Advisors. We are a $11 billion asset manager in Atlanta, and we are primarily a fixed income shop. We have a focus on structured credit within our investment strategies, and a number of our investment strategies are actually ESG integrated at this point. Nate, want to take it from here?
Gladly, thank you, Rob. Morning, everyone. My name is Nate Gabig. I'm a partner here at KPMG in our DC office. Our firm is spread across 142 member firm and countries, and my role is the representative for banking and capital markets ESG to our global initiative for decarbonization and impact investing.
Great. Joe?
Thank you. I'm Joseph Lau. I'm the Chief Operating Officer of Lord Capital. We are an ESG alternative asset manager based in New York. The firm was founded in 2003 on primarily governance principles, putting equity and subordinated debt in securitizations. Over the last 4 years, we've really added the environmental component and focused most of our energies on investing in financings relating to energy efficiency and renewables for commercial buildings.
Great. Jennifer?
Good morning. I'm Jennifer Thomas. I'm a senior analyst at Loomis Sales. My focus is in consumer ABS. We are very active in the securitized market. Our firm is generally a fixed income shop with a very strong securitized presence. We do have a focus on ESG and are continuing to expand our reach on the securitized side.
Great. And Manish?
My name is Manish Kapoor. I'm a managing principal at Westview Law Capital. And I spent a fair amount of time looking and investing in the renewable and energy efficiency space in the past, especially on the solar end, both in ABS and tax equity. And I think to me what's more interesting these days is the E component is very clear, but we're trying to spend more and more time on the S and the G, and look forward to talking about that more in this panel.
Perfect. So we do have a outline and framework of the topics that we want to try to address most directly today. We do also want this to be a dynamic conversation, and so certainly take advantage of the Q&A section to push some questions in our direction. We'll be happy to take those. But the topics that we wanted to make sure that we address today fall into, we were very scientifically arranged this into the E, the S, and the G components for the different asset classes. So we wanted to start out having a conversation about some of the esoteric securitizations that are current in the marketplace that are environmentally aligned. And Nate's going to be sharing some market-based experience around those assets. And then we wanted to open it up to the more traditional ABS, RMBS, CMBS, CLO asset classes and talk about some of the both environmental and social impact activity that we see in the marketplace right now and what's guiding some of that new issuance, especially in the US. And then to wrap up, we're going to sort of have a keystone to bring everything together under the governance component that Joe is going to be leading the discussion around. So we'll all be contributing at various points and sharing our perspectives. So we're looking forward to very dynamic interaction. And with that being said, we also wanted to kind of gauge the temperature of some of the people who are participants. And we do have a quick polling question. Caitlin, if you can put that up on the screen for everyone to access. So if you are a participant, you should be able to just check one of the potential responses to the question. Do you have an ESG rating framework for structured products? So again, we're trying to get our arms around the degree to which people have formalized processes to really rate or evaluate in some way structured products from an ESG perspective. Okay, so not surprisingly, a lot of people are kind of in the initial stages really of formalizing structure around ESG evaluation with structured products. And, you know, traditionally the ESG space was really grew up around equity investments. And that's because of the ease that equity investors have with voting proxies, for instance, and having an impact on management to do better around environmental and social and governance concerns. But over the past couple of years, the impact of fixed income, especially because globally the fixed income markets are about twice the size of equity markets, that lever to be able to pull as a fixed income investor has actually become more powerful. And I think the redheaded stepchild in some respects of the fixed income markets, though, is structured finance and structured credit. So we're really just starting to see people with some emerging tools and methodologies to be able to assess it.
Looks like Rob is having some minor technical difficulties. Manish or Joe, could we hand things over to either of you?
Sure, happy to take over. So, you know, I think we spend a lot of time thinking through the E component, especially in our hats as structured finance folks, where there's been a fair amount of solar, for example. So we might as well start with that. You know, let's talk a little bit about what's going on with environmental securitizations. What kind of transactions are we seeing? Do you want to kick that off, Joe?
I think you're on mute, Joe.
I'm always trying to keep that on so that you're not hearing any of the background noise. Happy to, but Nate, before we do, I know you wanted to talk a little bit about a number of exotic transactions that sort of cross over. So maybe we'd start at a macro level, and then we can start to drill into the environmental aspects, and then work through the E, the S, and the J.
Sure. And I just got a text from Rob here. It looks like Atlanta's being hit with a massive storm, so he lost power. So how much we all miss being in a nice conference facility somewhere together, challenged by the HTTP protocols. Yeah. So, you know, I think it was a really interesting winter. You know, if we look across the deal landscape, Joe, you know, there were a couple of points definitely wanted to hit on as it relates to, we continue to see quite an active solar market, including solar now breaching out from your traditional rooftop DG. We're also seeing community solar transactions now, which has been interesting. Those usually state-centered, locking in certain incentives, like you'll see there with Massachusetts Smart Program being very popular. Also, the incorporation of batteries. And I think we all saw just the tremendous impact of those storms in ERCOT just the month prior. From our developers and originators, it's interesting to hear now there's a much higher attachment rate and interest from homeowners that are interested in getting a battery paired system. They want, even if it's just a 3 or 4 day window for additional resiliency. So if you extend that to the value of the cash flow, there's more traction at that as we see storage becoming a bigger part of the discounted asset solar balance. Additional set of assets we're seeing more interest in is around intellectual property. We had a recent transaction that's now being paired from another issuer here now And this is going to be focused on storage and battery royalty payments and cash flow. So, truly exotics, we're seeing more activity as well for curious of impact. So obviously we can see Tesla's, people putting, a couple megawatt hour batteries in CNI transactions, but also artificial intelligence. For the first time, we're being asked to do some due diligence around what is the impact of an artificial intelligence investment. Could that particularly impact, to Manish's point, disadvantaged and or minorities, women? There's a certain sensitivity to ensure that these investments do not have a negative impact on job roles. We're putting people into joblessness. And on the final impact, I think we wanted to talk about was looking at green bonds and social bonds, especially where there's certain classes and the frameworks we like to specifically talk the most about are the ICMA, where there's eligible categories, specifically as it relates to the first-time home buyers. We're talking on mortgages, subprime auto for people that can now use a car and avoid being in public transportation. Also for refugees, there's a very interesting set, and the frameworks continue to move. There's also the climate bond initiative that's become quite popular for green bonds. I think we're over $1 trillion now, we read recently in some research notes. So that may be a good bridge. Rob, great to have you back. Maybe talk a little more about the mortgage-backed and social bond certification that goes into that for issuance.
Sure, happy to talk about that. So, just across all the different asset classes, I think where we've seen the most traction in issuance has been in the RMBS and the CMBS space, and really the agencies have been the leaders around this. So Fannie and Freddie have formalized both environmental or green and social impact bond issuance programs. And the focus for those organizations obviously has been around housing and affordable housing. And those issuances really started in the multifamily space. So Freddie and Fannie leveraged their existing multifamily agency programs to design incentives around commercial real estate related lending that incented the borrowers to implement environmentally friendly utilities or solar panels on properties, or to get designations from organizations like LEED, which certify the environmental positive factors associated with that property. And so pools of these have been issued under both Fannie and Freddie's commercial mortgage-backed securities programs. And more recently, both of the agencies have also begun to issue social impact bonds as well. And this is, again, largely around affordable housing issues. So pools of loans that are single-family residential that are being made to borrowers who are primarily low to moderate income, or first-time home buyers or other challenged borrowers. And so the agencies are really leading in the space. Although Fannie and Freddie are in some senses the market for a lot of those for a lot of the mortgage-backed securities that are out there, nevertheless, they wanted to demonstrate the integrity of their structures and decided to align with the ICMA, or the International Capital Market Association, green and social bond standards. So the ICMA is an organization that is probably, I would say, the most widely recognized market-based framework for social and green and sustainable bonds. And so Fannie and Freddie actually held themselves out to the market as being compliant with the ICMA standards, and also received certifications or validations from third parties that provided opinions that they were in fact aligned with those social bond standards. So that kind of integrity is important even for Fannie and Freddie to be able to say that they are adhering to those standards. And I think that takes us to a really important part of the discussion, which is this concern about greenwashing. So, ESG has just received a tsunami of attention, and just a flood of deals have come to market, and issuers are issuing green and social bonds. Asset managers are offering investment strategies, for instance, that align with green and social and ESG and sustainable strategies and themes. So how much of this is real and how much of it is really what we call greenwashing? So the hope obviously is that adhering to a standard that Nate referred to earlier, the ICMA standard, will bring some integrity to the marketplace and allay some of the concerns about greenwashing. But really, it comes down to, Angel, we take a very data-driven approach, and I think the agencies are doing the same, which is to demonstrate this alignment with green or social impact. You've really got to have the data to support that your loan pools and your collateral and your deal structure align with ESG principles. So some indications of that would be, for instance, having very granular loan level data about your collateral that captures information about the income status of the borrower, some geospatial data that can trace where that collateral is, where the physical collateral is, and whether it's in a low to moderate income census tract or other measures that show really the status from an income perspective of those borrowers, so that you can ensure that those loan pools and the use of proceeds of those loan pools are really being used for environmental or socially responsible impact. And a lot of this around housing is intended to expand the credit box and provide more housing and affordable housing to a broader pool of borrowers. And we're also, of course, seeing incentives for single family borrowers to implement environmentally friendly utilities, HVAC units, geothermal heating, adding solar panels to their homes, and getting certain types of certifications that indicate that they are, in fact, doing things that are environmentally sustainable. So I think really the critical success factor for any further issuance of RMBS or CMBS is really going to be around ensuring that you have the right kind of data provision and reporting that gives investors the confidence that you're really utilizing the use of proceeds in an appropriate manner, creating that transparency. So it's going to be a very data-driven approach. And
Rob, just one other thought that dovetails there, I think that's interesting, is we've certainly seen, whether it's real estate or military housing, but we're seeing qualified opportunity zones reach a maturation point as well, where we're now starting to see renewable energy portfolios and also some commercial mortgage-backed transactions. And qualified opportunity zones usually are very highly correlated to LMI census tracts. Obviously, no surprise there, but the significant tax benefits and tax savings you get from the deferral, the abatement, and capital gain savings certainly are enough to bring a very optimized capital stack to bear.
No, it's a good idea to bring attention to the opportunity zones, because that is the identification of those opportunity zones is important information, because a lot of investors were, I think, initially discouraged that they couldn't make a qualifying investment in some of those zones, like, for instance, an equity participation in a limited partnership for one of the structures that was created to take advantage of the opportunity zone tax breaks. But just knowing, like you mentioned, that correlation between those zones geospatially and that they're correlated with the census tracts where there are a lot of low to moderate income residents, that's very powerful, because then you can use that data to measure that impact. And Joe, you wanted to?
Yeah, and I was going to say we're also seeing quite a bit on the commercial side in those areas where the opportunity zone and all the benefits, because they typically seem to be paired with tax benefits of a qualified opportunity zone, the local tax benefits because of where they're physically located, even outside of the IRS benefits, means that the developers then have additional economic incentives to go to high efficiency or ultra high efficiency. So we're seeing a lot more on the environmental side that go into a lot of those buildings, which is allowing us then to provide incremental financing to them, because the opportunity set is significantly higher on a building like that. They're not just putting up a block of concrete. They're also looking to put in green roofs, specialized windows, all of the additional energy efficiency requirements. So it's not just renewables. It's how do we make this building actually not a net zero, an ultra high efficiency building, which then is providing incremental benefits to the neighborhood that they put it in.
Absolutely, and that designation is an opportunity.
It's good to just step back before we get too granular and ask two questions. One is, why should fixed income investors care about ESG, especially S&G, and what can make the market scalable? And for the first one, the way I think about it from my perspective as an investor is the answer is very simple. Usually when all of us are in fixed income, especially in ABS, we're dealing with brain dead entities by design. It's not similar to the equity world where there are board meetings regularly, and you get to vote on the board and the direction of the management. As a fixed income investor, from a formal perspective, leaving aside informal conversations you have with management, you have only 2 points of intersection. One is if and when you buy the deal, and if and when you sell the deal. Those are your only 2 formal intersection points, aside from an actual credit event. Everything else is informal and non-binding on management. Therefore, it makes a lot of sense to think very much in detail about governance of the top holdco, which effectively your CUSIP or non-CUSIP asset rolls up into. And if you look through a lot of the issues we have had in the market, and you try to look for common themes in the last, say, 30 years, what you will find is there are no common themes. They're all different. But the one thing which would have been helpful in all those cases is better insight into management and more disclosures about management. In all cases, that would have been helpful to the investors. So, that's kind of my thinking, why even if we are very quantitative ABS investors, investing in non-energy sectors, things completely unrelated to solar, it still makes sense to think of S&G. Mm-hmm. Then second, and in some ways just as important, what would make this market more scalable? I think people clearly see the value in ESG. You see that on the equity side, where ESG has become basically a fundamental add-on, similar to credit, and we are going that way in fixed income. The one hurdle we need to get around really is having somewhat fungible metrics. Right now, we have very fragmented metrics where all issuers, different industry associations, all have their different metrics, which I'm sure are well thought out. But it makes it very difficult to compare trades across assets or even in the same asset. And that simply does not help with the issue of greenwashing, where certain deals are self-categorized as being green, but you don't really have a lot of disclosure or enforcement. So, that's kind of how I think of it. And I think that's a good lens to think about ESG, and then we can do a deeper dive.
Just to add to that, I think I would highlight what Manish said about disclosure. I mean, especially across the ABS products that are non-traditional or even traditional, like consumer lending. The lack of disclosure for 144A versus public securities, I mean, you're not really even getting a loan. How do you tie out a lot of that information to make sure that they are, in fact, abiding by the S&G?
Yeah, Jennifer, I think you and I offline have had conversations about this. I mean, is there a way that investors or asset managers or others, market participants, can actually put pressure on some of the issuers to disclose that information, to become more transparent about the data, so that investors can make better decisions, especially in the private segment? The public registrants are pretty strong about providing data, but in the private sector, are there some tools or suggestions around how to interact with the issuers to incent them to provide more of that data?
I think for my, oh, sorry, go ahead, Joe.
Oh, no, go, Jennifer. I'll speak afterward.
I was going to say, from our perspective, we try to have a set of questions that we're consistently asking our issuers, and comparing and contrasting. Ideally, having an industry-wide set of disclosures or questions that everyone asks would be an ideal world, and then kind of forcing the issuers to, I've been asked this a zillion times now by the same investor. I will finally address it. I mean, us as a firm, our ESG has been huge on our fixed income side, and on the securitized side, we're a little behind, admittedly, but we're catching up. And we initially just started asking, how often are you being asked by ESG? And I mean, this is of course a few years ago, and to be honest, I was often looked at with blank stares from those type of issuers. But as we've had the conversations, it's becoming more and more part of the conversation, and they highlight social lending, a favorite in the subprime auto space is for lending to those in need.
Yeah,
so
I would just say anecdotally, to your point, I think some of that pressure may be working. For instance, Kroll KBRA, the rating agency, came out earlier this week with an analysis of the emissions data from subprime auto deals.
Exactly.
And that's going to probably create de facto the need to disclose that information, because now that's out there as a metric.
Exactly. I think that is key. It's just the consistency of the industry wide and trying to do such things as task force like this and establishing kind of some guidelines that people can run with. And I believe if the more you see that the issue is here, the more they'll address it.
Yeah,
The one thing which occurs to me as you were talking, Jennifer, is what's become really almost embedded in the DNA of these deals and the other deals we do is data has just become a key part of the process, where earlier it was an input. You were using collateral tables, you were stratifying them, that's what you were doing to actually do the issuance. Now you have a lot of data coming after the deal, which is equally important. And when it comes to ESG, ultimately, it's not just about the data, it's really creating the data, where in some cases, these were metrics which were never tracked even 10 years ago, which is not that long ago in the grander scheme of life. But now you are creating the data sets, you're creating the metrics. I think as you have standardization, you will see bigger players enter, where you look at Europe, even fixed income is far ahead of the US, where a lot of the large pension funds have hard-coded buckets, which have to be allocated to ESG. And I think that's also the other interesting point. I fully expect the SEC will be very focused on this issue, but this is an interesting part of the market where the investors have led the charge, where the large asset managers have come and said, we want you to do more on the ESG side. We want you to disclose more. We want you to do better. And it's not a relatively recent development. It's been going on for a good 3 to 4 years with a fair amount of energy and enthusiasm, where the investors have led the charge. And again, if you think about it, it percolates through the ecosystem that mandate for the asset managers is coming from retail investors on the street saying, we actually care about this. And you have firms like Goldman, for example, saying, unless you have enough board diversity, we will not do your IPO, which is fairly significant. When is the last time you saw investment bankers turning down a large IPO fee? That tells me about the amount of pressure coming from society, where people think there is real P&L value to this.
But you're also raising an important point, and it does build on what you said, Jennifer, and that is, what is the type of data, what's important, and it's qualitative and quantitative. So we've adapted over the course of the last couple of years our own frameworks that are necessary by each transaction. So as you've done, Jennifer, with the questions that you have, we have our specific requirements that we've been developing and continuing to build on. So it has to come from the investor side. And most of the transactions that we're going to be looking at in this space, especially in the private market, are so bespoke that you're learning as you're going along what are the factors. So something like board diversity has developed over the last year. It's the same thing that we can say in the environmental world, coming to understand better what are the key metrics, because you can speak to engineers and they can come up with a dozen different ways to calculate some type of carbon or environmental benefit. And then that doesn't correlate with someone else that you're speaking to. So the market's moving in different directions and hopefully starting to come together. But it's really, the more investors are asking questions and trying to understand, that we're getting a better idea, what are the needs? And then issuers understanding based on that, okay, these are the things that I have to do because everyone's asking me these things. And these are the additional items we hadn't contemplated, but it's an important point when we ask about the overlap. How many social factors actually are correlated with environmental? So we built out a series of social questions, social metrics that are core to our environmental lending, because we don't see that there are environmental deals, social deals, and hybrid deals. We see that the qualified opportunity zone component is actually a key one when it comes to much of our environmental lending. So it really is a process to continue to understand better. And we now go back on transactions that we have in place and attempt to understand better. And some borrowers are interested in that exercise and you have a good relationship with them. Others are not interested in providing additional information, but we're attempting to continue to update and build on our database of knowledge so that we're able to look forward and see, yes, how did we increase employment with the transactions that we have? How did we affect underrepresented groups? How is the total economic benefit increasing by putting up a building in an opportunity zone that now increases traffic and retail spend and so forth? All those factors are things that are very data driven. So all of us as asset-backed folks are very interested in how these work. They're just new metrics. So it takes time to figure out how you look at those. You may calculate them 3 different ways, decide none of those make sense, and you have to find a fourth in order to really be able to calibrate everything.
And Joe, it's interesting, given the long duration hold period, I mean, QOZs to get the full benefits is a minimum of 10 years, right? So over those 10 years, there are semi-annual reporting and filing requirements. So that's another element. This is not something where people concerned, oh, could I be accused of greenwashing, or could this bond expose me to purpose washing claims? It's one of the nice, elements that correlates. And I threw in the chat window, Manish, you were spot on about the commissions really starting to weigh in here. I think the administration's felt, enough pressure at this point. But early in their questions, of the 15 questions, one of them specifically tips the hand of, discussing TCFD as well as SASB. And I think that the rating agencies and some of the larger asset managers have done the market a favor by kind of focusing, if for SASB, 77 sectors, each one bespoke and set to its own set of metrics and disclosures, is, in our opinion, in certain ways we've seen, become table stakes in order to get a transaction done, being able to say, yes, we're starting to capture that data. It's not just hidden with the OGC, or it's not something that we can't capture. Just started to push them for their, for their origination strategies as well.
Yeah, and we just saw a question come up in the chat. What are some of the economic benefits of new building multifamily in an opportunity zone? Perfectly timely to what we're talking about. We're working on a project right now in a city where they're in the midst of a revitalization of their downtown network, and we're financing a multifamily property, mixed use, in an opportunity zone. And it's, the revitalization concept is mixed housing in the midst of retail and commercial space. So this is considered to be one of the hallmark properties in that part of town that's going to bring housing back into the city, and integrate that into a portion of town where retail has been struggling for an extended period of time. It's part of a main thoroughfare. So we've been working directly with the municipal authorities, the economic development folks for the county and the city, in order to ensure that this building is one of the key ones that's going to attract foot traffic to all the walking retail. It's going to provide, based on its footprint, a lot of additional access for other people in the area to make use of its retail, the restaurants and the small businesses that they're looking to attract. So there's a lot of different ways that this type of development can actually start to make these places focal rather than just destination housing and then people drive off to wherever it is they work.
Joe, I have a question for you. As you look at the market and from your perspective, do you see a lot of those areas and availability that could actually become a very large part of the market going forward?
I mean, I'd say more than half of what we're working on right now is opportunity zone related. And I mean, it's hard to call everything revitalization, but certainly part of economic development. I mean, it's a lot of projects now around opportunity zones seem to be a component of larger economic development. And to Nate's point, when the opportunity zone guidelines were initially introduced, it seemed like there was a lack of attention to them, or a confusion about how do these really integrate. And more now people are figuring out, okay, either we were waiting for our permitting or the master plans necessary for this to be integrated into a larger structure. And we're seeing some very, very substantial projects that are now looking to come into place in the next 6, 12, 18 months, and construction begin, where they're going to offer these broader benefits, where it's not a single-use property, where it's part of a multi-use development.
Have you noticed how many more conference calls or calls I'm getting from area codes in Idaho or Montana areas? I mean, I think COVID was kind of a great reset as well. We've seen it with a number of our work staff, right, that have moved to get out of cities. And I think QOZs were a natural jumping point to say, hey, there's a tremendous amount of benefits. You can twin them in many types, with other type of credits. We've seen a deal that had new market tax credits alongside it, right? I thought that was a very interesting scenario. So, Manish, you keep saying before, but on the S, right? The pandemic truly has put an entirely new lens on it, and seeing those, not just the economic benefit, but the secondary and tertiary impact that are being measured now too, with joblessness and the escape, from the poverty cycle.
Absolutely. And, I think what's interesting is you look at how successful Quaz has been, and you look at how solar tax equity was very helpful in basically spearheading the sector, where the rules of the game were somewhat clear, or as clear as they will be with government regulation. But that's been one tried and tested way, where effectively you try to incentivize ESG by paying investors not through yield, but effectively through the tax side, a tax credit form. To me, what's interesting is you're starting to see more and more market deals where you have certain metrics in the deal. And if those metrics are not met, there is a step up in the funding cost. Some might argue that step up is not very significant, but it certainly is there. It's nothing like a contingent convertible type of a step up, but there is a step up. There is a delta. And I think you're starting to see more and more people focus more on the G angle, as you mentioned. I think, the pandemic certainly brings it to the forefront. Issues which were somewhat more specialized, people are talking about it more. But I also think at the end of the day, these issues have to stand on their two legs, that they have to be P&L centric. And I do think a lot of investors who have done the analysis do understand that just from a pure P&L perspective, it makes sense to have the G component in there, to have the S component in there, where, a very simple example, you look at a lot of consumer lenders, especially the new platforms. When you talk to them, I never hear them say that my roadblock is access to funding. They always tell me my roadblock is I need more people to lend to. I effectively need people who are willing to be borrowers for me. And they're always looking for ways at looking away from the traditional FICO type scoring, looking at alternative data sets to effectively lend to people who are underbanked or unbanked. And for some of them, it's worked out very well. So for example, there was a lender I was talking to in Brazil. This is a couple of years ago, one of the larger lenders. And they were saying, when we look at our book and we look at the repayment rates, they are extremely high in our unbanked segment, because that segment realizes that if we don't pay back, we really have to go to people who are almost like money sharks, pay rates which are very high double digits. So to me, that's a great intersection where you're lending to people who otherwise would be taken advantage of, but at the same time, you are engaging in a P&L centric trade. So with all these issues, I keep coming back to the fact that it cannot be just because it feels good. There has to be an actual P&L motive, and I think that's a good thing. P&L is not a three-letter word, though it is a three-character acronym, but that's how really the markets move forward, and I think that's happening.
Mm-hmm. And tech is helping as well, Manish. I mean, we've seen securitizations now that have been on blockchain, right? And I'm now seeing blockchain being used for greenhouse gas reporting, because there's a mandate from one of our clients. The C-suite leader said, we will not do anything that's not on an immutable ledger. They didn't want to take any chance that any of their greenhouse gas emissions or other ESG data, could be manipulated. They wanted it straight from sensor level up through the platform reporting. So I think you're spot on there.
Yeah, I mean, in preparation for this panel, we had a significant amount of discussion on the G factor, and I personally think that in many respects it is the single most important, especially for a structured investor. We just always run out of time, and there's so much to talk about in ES and S that in many respects we don't give enough credit to the governance angles. And the dichotomy is that in many respects people look at governance in ESG and they think of the way It's described for equities, which is corporate governance. How well is a company managing themselves? It's the negative side of misreporting and corporate malfeasance, or the positive side that they're doing something positive for the culture or the environment in which they operate. And they forget that structured finance is built around governance. So everything we do is documentation. It's ensuring structure is appropriate and capable of ensuring repayment, and what happens when that fails. And realistically, when we think of situations, what happens when an issuer goes bankrupt and they suddenly decide that those assets are actually theirs and they can give them to unsecured creditors? What happens whenever your collateral was never really what you anticipated it would be, when there were problems with reporting over extended periods of time? All those factors are things that we believe we've structured to, or COVID happens. The emphasis on that is something that everyone on this webinar focuses on a daily basis. We hope we've structured well, and certainly we make every effort in order to make sure that that is the case, but it's solving for the unknown. And the last presentation this morning, the concept of tail risk came up. It's always a matter of, is our governance structure, is our servicing, are our documents, are the counterparties, are all of them operating in a manner where we're protected, because the unlikely can occur, and when it does, how do we manage that?
I think that's a great summary for our panel, and it looks like we're right on time, so we should probably end right now. It's been a great panel, and all of us are happy to talk more if anyone wants to reach out to us to talk through ESG.
Absolutely.
For sure.
Thank you, everyone.
Thank you.
Thank you.